The recent findings from S&P Global's Flash U.S. Composite Purchasing Managers Index, PMI, for April reveal telling signs of a potential deceleration in the American economy. This index, which integrates insights from both the services and manufacturing sectors, slid to 50.9, the lowest figure observed in 4 months. This decline from a March reading of 52.1, previously below the expected 52, signifies a subtle yet noticeable cooling off from the more vigorous growth rates experienced earlier in the year. Chris Williamson, chief business economist at S&P Global Market Intelligence, offered a nuanced perspective during a discussion with Yahoo Finance. He pointed out that although the PMI index still shows growth with a figure above 50, the reduction from the previous months indicates what he described as a little bit of a wobble in the economy's performance as it enters the second quarter. It will be interesting to watch this and see how that persists, Williamson stated, observing that the economic outlook for the second quarter isn't as promising as the robust first quarter, which surpassed many analysts' expectations but is now evidently losing some of its initial momentum. April's data also highlighted a downturn in overall business confidence, which plummeted to its lowest level since November after reaching a 20-month high earlier in January. This erosion in confidence coincided with other concerning trends such as a reduction in new orders for the first time in 6 months and a decrease in employment levels, which have not been seen in nearly 4 years. According to Williamson, the downshift in business expectations for the upcoming year is likely influenced by a shifting narrative around monetary policy. Market sentiment at the start of the year was buoyant, with expectations of 6 to 7 interest rate cuts by the Federal Reserve. However, these expectations have been significantly pared back, with the current consensus now only forecasting about 2 cuts in 2024, as per data from Bloomberg. The recalibration in rate cut expectations has precipitated a considerable rise in Treasury yields, particularly notable in the 10-year Treasury yield, which has surged nearly 80 basis points since February. This uptick generally reflects tighter financial conditions, which can adversely affect sentiment among businesses and consumers alike. Williamson elucidated, "You've got demand pulling back slightly as a sort of readjustment of the demand environment in the light of this new rates environment. This suggests a cautious approach by businesses and investors as they navigate through adjusted expectations of monetary policy." The cooling economic growth evidenced by the PMI report for April not only highlights a slowdown, but also aligns with broader concerns that inflation may not be receding as swiftly as hoped, despite previously strong economic performance. Even though the growth is tapering, the bond market responded to the release of the PMI data with a slight easing, as evidenced by a decrease in the 10-year Treasury yield by about 6 basis points immediately following the announcement. These complex economic signals underscore the fragile equilibrium currently being navigated by the U.S. economy. With inflationary pressures, fluctuating interest rate expectations, and slowing economic growth all interacting within an intricate fiscal landscape, the financial markets remain highly sensitive to new economic data and its implications for future monetary policy and economic stability. In the coming months, it will be critical for policymakers, economists, and market participants to closely monitor these developments, seeking to understand the evolving economic narrative and its potential impacts on both domestic and global economic scenarios. As we move forward, the ability to adapt to and manage these multifaceted challenges will be paramount in maintaining economic stability and fostering sustainable growth.